Wall Street surged on Wednesday, the Dow up 400 points, the S&P and Nasdaq each climbing more than 1%. The catalyst was a single word: ceasefire. President Trump claimed Iran's president had requested one, and markets moved before anyone could verify the claim. Airlines jumped, oil fell, the dollar index slid past 99.30, unwinding most of March's safe haven rally in a single session. But here's the part the rally doesn't price in. Trump attached a condition: the Strait of Hormuz must be open, free, and clear before talks begin. 1/5 of the world's oil passes through that 21-mile waterway. BlackRock's Larry Fink warned last week that oil could hit $150 a barrel and trigger a global recession if Iran retains any control of the strait after hostilities end. Jim Bianco of Bianco Research called the economic effect of that scenario incalculable, arguing it would effectively elevate Iran to superpower status. Signum Global Advisors told clients it is extremely unlikely Trump would leave without reopening the strait, citing damage to the U.S. economy, harm to Persian Gulf allies, and a comparative global disadvantage. Wolf Researchers Tobin Marcus offered a more nuanced read: Trump might be willing to withdraw eventually if the cost of war becomes intolerable, but not imminently. Former J.P. Morgan strategist Marko Kolanovic was blunter, warning the rally looks more like a setup for further declines than genuine de-escalation. The market is trading a headline, not a resolution, and Trump's national address Wednesday evening could either confirm the off-ramp or reveal an escalation, possibly targeting Iran's nuclear sites or energy infrastructure. Until the strait is physically reopened, every rally built on ceasefire talk carries a structural vulnerability that one contradictory post on Truth Social can erase overnight. That same gap between narrative and reality showed up in a very different place on Tuesday morning. Oracle employees opened their inboxes at 6 a.m. to find a termination email from Oracle leadership. No manager call, no HR meeting. Access to company systems was cut immediately. TD Cowen estimates the cuts could reach 20,000 to 30,000 workers, making it the single largest tech layoff of 2026. The reason is not declining revenue. Oracle posted a 95% jump in net income last quarter to $6.13 billion. The reason is AI. TD Cowen projects the layoffs will free up $8 to $10 billion in cash flow to fund a $156 billion data center buildout. Oracle has already taken on $58 billion in new debt within 2 months, and multiple U.S. banks have reportedly pulled back from financing its projects. The stock is down more than 25% year to date. On Polymarket, the AI bubble burst contract jumped to 22% from 17% in late February. A separate contract gives a 55% chance that U.S. unemployment hits 5% this year, up from the current 4.4%. Analysts at TD Cowen warned that Oracle's playbook of swapping headcount for compute may become a template for enterprise tech. Steve Eisman, the Big Short investor, noted Oracle's credit default swaps had hit their highest spread since 2008, but dismissed bankruptcy risk, calling the CDS market extremely illiquid. The layoff market, he implied, is not. Meanwhile, SpaceX filed confidentially for what could be the largest IPO in history, targeting a valuation of $1.75 trillion and a June listing. 21 banks are lined up under the codename Project Apex. The juxtaposition is jarring. One company fires 30,000 people to afford AI infrastructure, while another raises $75 billion to build data centers in space. The capital is flowing. The question is whether it is flowing toward productivity or toward a second dot-com era buildout with no payoff.
That question now has a formal answer from the Federal Reserve itself. Economists at the St. Louis Fed published a paper arguing that AI optimism is functioning as a classic news shock, one that drives inflation whether the technology delivers or not. The mechanism is straightforward. Households interpret AI adoption as a signal of future pay raises and spend more today. Businesses treat it as a promise of productivity gains and invest more now. Both forces produce what the authors call an inflationary surge in aggregate demand. Total factor productivity growth has averaged just 1.11% annually since ChatGPT launched in 2022, below the historical average of 1.23%. The hype is outrunning the output. The authors draw a direct parallel to the dot-com era. Paraphrasing Robert Solow, computers are everywhere except in the productivity number. Markets are already responding. Goldman Sachs notes that investors now assign a 45% probability to the Fed hiking rates in 2026, up from just 12% before the Iran war. Goldman disagrees. The firm still expects 2 cuts this year, arguing the current oil shock is smaller than the 1970s, the labor market is softening, and wages are growing below the rate consistent with the Fed's target. But the ISM Prices Paid subindex jumped to 78.3 from 70.5 on Wednesday, well above the 73 consensus, pointing to intensifying input costs that complicate the Fed's path, regardless of what Goldman believes. The weight of evidence tilts toward rates staying higher for longer rather than moving in either direction soon. The Fed is caught between an oil shock it cannot control and an AI investment cycle it may not want to cool. If Friday's non-farm payrolls come in strong and the ISM price pressures persist into April, the rate hike probability will keep climbing, and the stocks most leveraged to cheap capital, the same AI infrastructure names driving this cycle, will feel it first. If payrolls disappoint and the Iran situation genuinely de-escalates, the two-cut path Goldman outlines becomes possible again. Watch the 5% unemployment threshold on Polymarket and the 10-year Treasury yield around 4.85%. Those are the numbers that will tell you which scenario is winning before the Fed says a word.